All right, good morning. It's March 20th, 2021. I want to point out a couple of things. Down in the description, I've got links to a Spotify playlist so you can enjoy the music while you watch the show or while you're doing your own trading homework. Also, I've got a link to a previous video from a week or two ago where I talk about rolling options. So I'm not going to talk too much about rolling options in this video because I covered a lot of that in the previous one. So this one, what I want to do is talk about the different, more exotic combinations of options that we talk about on the show and give a more in-depth breakdown of them and talk about the situations where you may want to use some of these different combinations and learning what they're good for, when they're good, when they're not good, that type of thing. And so grab a drink, grab a snack, whatever. I've got this Michelob Ultra Organic Peach Pear. It's just a really light drink, and it's loaded with water and stuff, so help rehydrate. So here's a rundown of some of the combos we're going to talk about in the video. We're going to talk about the swoosh combo or the swoosh position. We talk about this one a lot. It's very dynamic, very useful. We're going to talk about the ratio back spread. We're going to talk about call walls and put walls and 1-inch punch trades. We're going to talk about how you can take a long volatility position and how you can take short volatility position in just about anything, and when you may want to be doing those things. So let's start with the swoosh, and it's kind of a variation of the straddle, and it's also it's kind of like taking an outright long position as far as the margin goes. Like, you're not saving much on margin. So let's pick one thing and look at it. Like, how about let's look at it on two things, actually. We're going to look at it on something with a high implied volatility and something with a lower implied volatility, so you can see the difference. I generally use this for stocks that don't have a very high share price, and so it doesn't make sense to do some of the other kinds of trades. Like, if you have to buy hundreds of contracts to take a position, that's maybe a lot less efficient than doing it with a swoosh, and it has to do with going further out on the calendar. So going further out on the calendar lets you pack more capital into the trade with fewer contracts, and that can save you on commission, bid-ask spread. All these things matter when you're rolling. If you have to roll, or if you want to exit the position for whatever reason, it helps if you've got lots of liquidity and not too many contracts. So let's look at GameStop. GameStop is kind of expensive now per share compared to a lot of other stocks in the market. I'm going to put the chart up here in just a second. And GameStop isn't really the best pick for doing a swoosh position because the implied volatility is so high, but that's why I wanted to show it. Like, this is one I would not use for the swoosh. So we're going to look at GameStop. Here's what that chart looks like. And then let's look at Camping World Holdings is one that I just put on. Or no, let's look at GM. Let's look at it with GM. Yeah, so I have this one too. So GM, it's much lower implied volatility. So it's basically the opposite of GameStop. The GameStop share price is higher. But let's look at how to construct the swoosh position. So for some people, this may be their first time seeing it. So if you've already seen it, then sorry. So here's the idea. We're going to do this with GME, and we're going to do it with GM. And we'll compare the two. So here's how you build it. You go out about somewhere between 3 and 6 months on the calendar. I'm going to go out, it's March now, I'm going to go out to September. And there'll generally be a contract month with that time frame. And it's a combo, so we go into the strategy builder, and we're going to buy an at the money. So the price for GM right now is 60. We're going to buy an at the money call as part of the combo. And then the other thing we're going to do is we're going to go for a very short dated put that is about 10% out of the money. The reason is we want the put to be cheap. The put should basically evaporate as the trade works out, and you'll see what that looks like. So I'm going to put it, let's go with the 55 strike. The idea here is you're buying protection, you're buying it short dated, you're buying it cheap, and you're rolling it. So I don't let this put get less than 2 weeks till expiration. I'm rolling it and keeping it 3 to 4 weeks out. Now there are exceptions to that. If you are only 3 months out on the calendar instead of 6, I mean you basically want to roll this the whole thing. You don't want to let this. Hey, I don't want to get ahead of myself. Let's keep talking about the put here. So the put should be between 25 and 35% of the price of the call, and not more than 35%. So when the implied volatility is high, the puts are super expensive, and you'll burn up a lot of capital on the puts, and it makes the swoosh not as good of a way to put on the trade. So this put is 82 cents. Let's look at the call and see the price of that. The call is $7.60. So that put is like super cheap, and it may not give us the protection that we need. So let's take a look. Here is the option simulator. Yeah, with the implied volatility so low, that put is working. It looks like a Nike swoosh sign on the option simulator. That's why it's a swoosh position or swoosh combo. So what we can do when the implied volatility is so low is we can actually move it closer, and we're going to pay a little more for that put, but it's going to protect us better, and it will also time decay slower. So let's take a look at it here. I mean, the other thing you could do is go out a little further. So yeah, the put is super cheap. We've got a nice looking swoosh, and what happens here is if the stock goes up or the stock goes down, we make adjustments. If the stock goes up, basically we're just rolling that put and at cheaper and cheaper prices, because the call will come to dominate the price of the put. The put won't even be a factor really, but you want to keep it. The other thing you can do is if the puts get super cheap is you can roll up and strike. However, the idea here is just to protect your capital at entry. It's not to protect your gains. You have to protect your gains differently. You can roll up in strikes depending on your objectives. What you may want to do though is you may want to eventually exercise the call and take possession of the shares. If you do that, you'll want to do that either at expiration or when the delta gets really close to 1. Let's talk about the margin requirements for this. So this costs $866 to put this on, because we could see that the price of it, it's not showing us a bid ask. But here's what you could expect to see there. On the bid ask, it would be the ask would be about $8.66 would be the price of the combo, and then this is how much it would cost you to buy it. Because it's options, you got to multiply it by 100, 866. So compare this to just taking a margin position in GM. That would take if you're using 2 to 1 margin. It would take you $3,000 to buy 100 shares So I also want to compare this to a synthetic stock position. We can do that in a minute. I don't know that we're done talking about this one. Let's play it forward through time. So as we play this forward, you'll see that it drops here. It comes, the dotted line is where you can expect to move for the price on the current day. And the solid line is where the price of that combo will be at expiration. Or at least it's a simulation, right? So it's a guess. And these things change all the time. Like the changes in implied volatility can really alter where this dotted line is. So if we go out a few days, like let's actually scroll out a week. So March 26th is the first Friday where we'll have held this combo for a week, and that's where I'll be looking to roll the put. And so if GM didn't go anywhere, then I'm down $50, and guess what? It's mostly from the put, because there's very little time decay on the call, because the call is at the money. So we'll look at that separately. We'll look at the put and the call separately, and you can see that put is doing most of this time decay. So the other thing is, think of it like a rocket ship that needs a huge burst to get into to escape the Earth's gravity. And that's kind of how this is. Like if this position takes off, then you don't care about the put, because the put's just there to protect your capital at entry. Now, if the stock does launch and then has a huge backswing, well, guess what happens? You fall back down deeper into this well because more time has passed. And so the gravity well right there at 56, the bottom of this is where the put is, because if you let that put expire worthless, if you just carry this position, you don't maintain it, then that put is going to weigh heavily on this. So by something about options expirations, it's like or time decay, like you get the most time decay in the last 2 months, in the last 2 weeks, in the last 2 days, in the last 2 hours. And so, and really for a position like this, the last 2 weeks is where that put is going to crush you. So let's actually look at that. If you look down here, look at that. It's the put. The put is basically worthless, and it's not even really giving you any protection at this point. Like the protection it offers is weak compared to rolling it. I mean, the other thing you could do is you could try and get something really short dated, but I like doing that less. I like to have it about 2 or 3 weeks out and rolling it. Really, I try and roll it 3 weeks out and then push it out to 3 weeks. So let's look at just the call, and I'll show you a trick here on the call. So here's what we can do. Let's go as far out where we still have weekly expirations. So we'll go out to April 30th, and let's look at the 60 call there. You see that's $3.60. So it'd be much cheaper to get this, and it's not going to have much time decay at the current price. So watch this, $3.60, right? Now let's look at the one that has a week less on it. So if the price doesn't go anywhere, $3.35. The difference there is 25 cents. So you're looking at 25 cents a week of decay for the at the money call with this duration. The one all the way out in September is going to be decaying even slower. And here's how you can know that, because if we look at, if we go 3 weeks out, look at the 60 call, 263. Now let's look at 2 weeks out. So this one had a difference of 64 cents. So you could think of it, if GM didn't go anywhere and there were no changes in implied volatility, like all else being equal, the 60 call with 3 weeks to go it's decaying at a faster rate than the 60 call with further out on the calendar. And now let's look at with just 1 week to go. So yeah, you can see it's burning up really fast now. And if you look at the puts, because they're out of the money instead of at the money, they're burning up even faster. So this should give you an idea about, this is how you can get a feel for how much time decay you can expect besides just that simulator. So we've got $1.03 for this 56 put. $1.03. And we go here, 64 cents. And then here, it's 29 cents. So burning up real fast at the end. So I talked about the swoosh position being kind of similar to a straddle. Let's talk about a straddle for just a second. If you think that volatility is going to rise, a way that you can get long volatility on anything using options is with the straddle. And the straddle chart, so to make a straddle, you buy a call and you buy a put. Generally, these are done at the money. And here's what that looks like. So this is going to burn up fast if the stock doesn't go anywhere. And this only has 6 days to go. But if you notice, it looks kind of like the swoosh. But this is deceptive because it has a very high rate of time decay. This is not a position that I would normally put on. There are times to do that. If implied volatility gets low enough and you think that a stock could either like break out or break down, you don't know which way it's going to go, and you pick the right time frame, then that could be an effective thing to do. Okay, so we talked about the time decay aspect of the swoosh position. Now let's look at why something with a really high implied volatility, the swoosh position isn't going to do as well. So we talked about looking at GameStop, so let's do that, and maybe we could look at Riot too, because Riot's share price is almost the same as GM, so I think that'll be helpful. All right, where is GME is 199. So to build the swoosh, we're going to go out. In this case, we're going to go to October, so it's a little further out on the calendar. And we're going to buy the at the money call. And we're going to go and get a 3 week out put that is 10% out of the money. And this one is, this put is expensive. It's like 25% of that price. Or no, it's bigger than that. How much was that call? $106. So, I mean, you see how expensive that call is? It makes it almost impossible to construct this. So it crossed over that top end of 35% of the price of the call. And so if you look at this position, I mean, it just looks ridiculous. Like, where are you going to make money? You need GameStop to really move. And you're burning up so much time decay. I mean, look, if we just play this forward like just a few days, look at that. It's time decaying so much, and the put's not even protecting you. Look, I mean, if GameStop loses 25%, you're still losing a ton of the money you put up. In this case, I mean, it never really protects you. So that's why a swoosh position is not really an effective way to take a position in something that has a high implied volatility. Let's just quickly look at Riot and then we'll move on. So the Riot share price is almost exactly at 60, so very much like GME. Hopefully there'll be a September expiration. Yes, there is. So this is a very good comparison. So we're going to buy an at the money call, and you can already see that this is way more expensive. I think the call on GM, here, let's actually look at that. The call on GM was $7.60. The call on Riot is $28.55. So same expiration, same strike, and the underlying is almost the exact same price. So there's a lot of things that can go wrong between now and September for this call. So the other thing we need to talk about is we talked about what happens if the price goes up, but we didn't talk much about what happens if the price goes down. So we'll go back to GM in a minute and talk about that. But first, let's build this out the same way. So the put, I'm looking at a 54, which is 10% out of the money. It's $5.70. I wish IB would show the prices of these things here. They do on the mobile app, but not here. So I have to do a lot of clicking around. So the put is within the percentage of acceptable percentage. I talk about if it's 25 to 35% of the price of the call, then you're generally okay. So yeah, I think that's probably all right. If you look, yeah, it does give you some protection. It burns up fast though. So if we look at a week out when we're going to roll it, that put has burned up a lot of capital if the shares didn't go anywhere. So this is kind of a dicey one to put on. All right, so back over to GM, and let's talk about what to do if the share price falls. All right, let me rebuild the combo. I'm going to get a at the money call. And we actually got to use a pretty close by put. So this is better than 10%. I mean, you could even use this one. Let's use the 57. Let's take a look. So the 57 is going to decay less. So there it is. There's a swoosh. And the 57 strike is going to decay less than the 56 or the 54. So that's something to consider. Like, even though you may be paying more to have it close to the call strike, you may be losing less on time decay. So it may be worthwhile to do that. And some people may even want to roll the puts at the same strike. But I don't like doing that because of what happens when you're right. If you remember, the thesis for this is that we're taking a long position. And maybe with the goal of eventually exercising the call. We're not, I mean, the put is just short dated protection. So what to do if the share price goes down? So if you're expecting a breakout and you get a breakdown instead, you may not want to be in the stock anymore. But what you can do, so let's say a few days out, the price the share price drops. Say it drops 10%. GM is now at 54. Well, we have a small loss, but we basically still have all of our capital. So, I mean, just $36 less, and what we put in was $900. So we've barely taken a dent. And what we can do, please remember that when I talked about the call, that we want the call to be at the money for our entry, and while we're sitting in it, we want it to be at the money or in the money, and that's because the time decay on it is very, very slow when it's at the money or in the money. But when the price drops to 54, the 60 call is out of the money now. So guess what we could do? Is we can do a roll, and I have a link to a video below about rolling. You can go back and watch that one if you haven't seen it. I go into quite a bit of detail about rolling, and what you can do is roll your call down in strike on the same calendar from a 60 to a 54, and simultaneously roll your put probably out into the next week, and then down in strikes as well. So that you essentially reset the position, but with 54 as the starting point instead of 60. And what that can do is essentially let you get your entry on the stock perfect. You can pretty much get in at the low, and you are paying a time decay for being in this position. So ultimately, you do need to be right to make money. But it's a really safe way to take a position in the stock, and I think it's efficient use of capital too. We're talking about only 2 contracts, and we've got $900 at work. Now, not all of that is on the long side, but So this worked well for me with Riot. I'll talk about a real example, and I talked about this on the show at the time. Let me get the Riot chart up, and let's zoom in on it. Hang on a second. Okay. Oops. All right. So here's Riot. I put on a swoosh position in Riot. I think it was right here. It was around 20. I think it was here actually. It was at 21 or 22. I put on the swoosh, and then what happened is Riot fell to like 18, and I reset the swoosh at 18 basically for free, and then I wrote it all the way to, I think I sold some around here, and then I sold the rest on this big down day right here, I think where this wicked. And I haven't really been in Riot much since, just doing small little 1-inch punch trades on it, which we'll talk about soon. So anyway, that's a real world example of how you can use this to essentially like get your long position, get your money packed in there at the low, and also protect your money at entry. So it's a very powerful technique. Chris and I used this on a trade in energy. I think it was from our Wednesday night show last week. We shorted USO using the swoosh. And it worked out great. I mean, it's broken down. It's since bounced a little bit, but I mean, I was quickly up 50% on that trade. So you can go back and rewatch the video for it's the very end of the show is where we talked about this. I don't know how long I'm going to hold it. Probably I'll discuss that with Chris. He may already be out. I don't know. I mean, it was fast money, and he was right. His timing was great. So we did this, but with puts, and we did it much more short term. And so if you shorten the duration of the call, or I mean, if you shorten the duration of the direction you're trying to take. So in our case, we were betting short. We used a put that was at the money. We had a much more short dated call that was 10% out of the money, or maybe it was not quite 10%, something like that. Because the percentages are a little different with this. All right. Anyway, so what's next? Let's talk about the ratio back spread, because that's pretty complicated. So with the ratio back spread, by the way, I forgot to mention this book, Options as a Strategic Investment. They talk about ratio back spread in this book. It's a great book. I recommend everyone using options get a copy of this, because you may find it helpful to come up with the best way to put on a trade. So let's talk about ratio back spread. Here's what it's good for. It's good for taking a directional view where if you're wrong, you don't want to lose any money, but you don't mind paying time decay either, because you foresee an explosive move higher. It's a position that is long volatility, so when implied volatility rises, it will do better. And also it's directional, but just one directional. You can put on one on the long side and the short side, but you're gonna using calls and puts. But the problem with that is you're gonna pay a lot in time decay, because it's on the side you're wrong. It's costing you time. Anyway, let's look at hypothetical here. So I don't have any on right now, but we could look at. Let's look at Tesla. So say we wanted to get long Tesla, and we didn't know how far it was going to drop. You want to be mindful of the implied volatility. So when it gets volatile, You don't necessarily want to be putting these on. They can get hurt. They're just really expensive. So let's talk about it. Let's build one for Tesla. I do these with a fairly short duration on Tesla when I do put these on. And so the implied volatility is basically going to dictate how much time you can have for these. So something like TLT, I have a ratio backspread on calls for TLT right now, and the implied volatility is very low in TLT, even though it's falling quite a bit. So what that allows me to do is have a lot of duration and also pack a lot of calls into the ratio part of it. So here we are in the combo builder for Tesla. Let's look at for 2 weeks out. I find that generally with Tesla, unless there's an upcoming earnings or something like that, if there's an earnings coming up, then it's not really good. The other thing is if there's a dividend coming up, you have to watch out because you can get assigned on your short leg. So let's do this with calls. Right now Tesla is at around 650. So the idea here with a ratio backspread, if we want to build one, is we're going to sell an in the money call, and we're going to buy an at the money call. I know it's 652, but I'm going to go with this 650 because it's got a lot more open interest and volume, and so it'll be easier for me to get in and out of this leg than the 652. And so if you look at what we've built so far, the margin requirement for this is $1,500. Also, this is a credit. So we can see right here that we're going to be credited $667. And so in order to make, this is not a ratio backspread yet. In order to make this a ratio backspread, what we do is we take this $667 and we go buy some calls. And there's a few ways you could do it. You could put them all at one strike. Like that would be doing it like this. Maybe I miscalculated this. Yeah, I've spent too much. That's the problem. I built this wrong. So I don't know why it's. I think I'm misunderstanding the credit. Okay, it's $6.67 that we have to spend. So I can't get that $6.65. The implied volatility is high, so we have to go very far out to find a $6 one. Let's get the 750. So this probably isn't a trade that I would want to put on because the implied volatility is so high, so we have to go so far out. So right now it's a back spread. If we make it a ratio back spread, what we do is we get rid of this one and we get 2 or more calls that are even cheaper. So we could get 2 of these 785s. Let's do that. So by the way, I invite you to enjoy the Spotify playlist in the description while you're watching the video. I listen to it all the time. Micah helped me make that list, and it's great music for trading homework. All right, so I don't like how far this the stock has to move. I mean, it's very unlikely to get all the way up here in 2 weeks. But the thing to remember here is you're probably not going to carry this position all the way till expiration. The idea is that the stock will move along this dotted line. So if you go, if you watch me play this forward, you see that it takes some pretty heavy time decay. So for $1,500 of margin, in just a few days, it burns up a lot of that margin. if the stock doesn't go anywhere. So they can be good. It's very situational. Like if time is cheap and the implied volatility is low, then these can be an effective way to do it. But with Tesla, right now, not so much. Let's roll this in 1 week, and you can see that if you only give it a week, it'll be a lot cheaper looking. So let's go ahead and do that. So we're going to build it the same way. We're going to we can even use the same strikes for the beginning part of this. So we're selling a 635 in the money Tesla call. We're buying a 650 at the money Tesla call. And that gives us some credit. It looks like, what's our credit? About $6 again. Okay, cool. We're going to get 2 of these 735s. So we didn't have to go out quite as far. But with the implied volatility on Tesla as high as it is right now, I don't think that this is a good choice for how to do it. But you can see that for 1500, if Tesla does move big and it moves fast, you can make a lot. And if Tesla drops, like that's the beauty of the back spread. If Tesla drops, you don't get destroyed on your like if you just bought some calls instead to get a similar upside. If Tesla has a down day, you get destroyed. With this, it's just time decay basically that hurts you. So the other thing is you're moving quite a few contracts around. So if the liquidity's bad, then you can get trapped in these or get hurt badly. Because Tesla has a pretty high implied volatility, let's talk about how to short volatility. Like if you think that we're kind of at the end of this down move, I did want to get into some short volatility combos too. So let's look at 2 weeks out. Earlier I said that time decay happens most in the last 2 months, in the last 2 weeks, in the last 2 days, in the last 2 hours. Well, let's look at time decay position on the last 2 weeks because there's weekly options here, so that's nice. If we want to short volatility, then first of all, let's just get a feel for the Tesla chart. I'll bring that up. Okay, and then the other thing I'm going to look at is this ATR. Let me flip to a daily, though. I want to see the daily ATR. 48. Okay, so I mean it's pretty high, and at a lower price than it was up there. So there's a few ways to go. Currently Tesla's at 650. So let's start with an iron Condor. No, actually, first of all, let me show you something simpler than that first. So we talked about a straddle earlier. See here, 650. Okay. So if we think that the volatility is going to come out of Tesla, then probably the price will be rising too gently. And so a straddle is going to get burned up. And mostly it'll be this put that burns up, if you're right. So you don't want to straddle because Tesla has to move a lot to get out of this gravity well. And so really what we're doing is we're going to look at taking a short position on that. But we have to do it in a controlled way. So if you just short that straddle, because you want to short volatility, look at the margin requirement there. 20 grand to do that. And this margin requirement can change too. Like if Tesla moves around a bunch, you could see this margin impact change in a way that it gets even bigger. So a really expensive way to do it. You have a wide range of break even though, so that's kind of nice. I'm not sure what those percentages are without thinking through it. The other thing is, like, this is estimating that it has a 55% chance of profitability. Well, I'll show you a trick about how to take advantage of that. So if you want this position, but you don't want to post 20 grand for it, watch this. If we come out 1 week on the calendar and we buy the straddle there, this straddle is going to time decay slower than this straddle. This straddle is going to time decay faster. So now look at the position. So the max loss is controlled. This is what your max loss will be. And of course, the range of profitability is lower. However, the maximum return is bigger than your minimum investment here. So there are a few things you could do about this. If you don't like the idea of maybe like Tesla making a big move and you losing this capital, first of all, realize that it takes time. So you don't necessarily like hit the worst case scenario right away. Like if you get outside that profitable zone, like even if you come to the edges, you can generally close it out without getting hurt too badly. Like if we play this forward, I mean, it's not really moving much until you get very close to expiration. So anyway, let's look at how we can maybe do this in a little bit different. What I'm going to do is just say, okay, well, if volatility comes out of Tesla, actually, I think it's going to go up quite a bit too. And you can get further. You can go further out of the money for cheaper. So let me flip all these to say 700, and then we'll look at it again. Okay. So now you can see the minimum investment has gone down. It's not as big, and the potential profit is still quite large. So other things you can do is you can bring this in or out on the calendar to get it how you like it. But this is a short volatility position basically, and so really what the bet is that Tesla is going to rise, and so. Let's pull these in on the calendar, the ones we're selling. And I'm going to pull the ones we're buying in also. So when you pull, if you keep these further out on the calendar, then you're essentially putting a bigger, you're posting up more capital, but you're in a stronger position. So you can see now how it's much cheaper. That's because there's less profit to earn from this position. But it still makes quite a bit. So I kind of like this a little bit better with a very short date on it. The other thing to watch out for is, let's see here. If there is, whenever you're shorting calls or puts, you have to watch out for if there's a dividend. With Tesla, we don't really have to worry about that. The other thing that you can do is you don't have to do it with the puts. You could just do it with the calls. And it's a very similar looking position. See that? It didn't change it much. It's just cheaper now. And I mean, so it still looks good if you just do it with calls. The reason I simplified it like that is because now I'm going to show you how we can actually use a credit to fund this position. And so I took the puts out, you noticed. Well, watch, we're going to add some puts in here in a second. So this is, I call this like a calendar condor. I don't know what it's called, but there may be an official name for it. So what we're going to do is we're going to essentially put on like the bottom of an iron condor. And so hang on. Watch this. Before I make that switch, let me talk just a little bit more about these calls. So I took the puts out, and now we can analyze just making some adjustments to these calls. And then I'll show you the calendar condor. So if we do this, let's put the call we're buying a little further out. Let's put it, yeah, that's probably good. So if you notice, it's cheaper now. It's more aggressive, though. And it's still got very similar profit potential. So this is a little bit more aggressive. It's cheaper, but look, the margin impact is now higher. Because if Tesla overshoots your target, then look at what happens. You know, that's where this margin comes into play. So on the downside, it's all right, but we said we're bullish, right? So we're not as worried about the downside. So now let's turn this into a calendar condor, and the we've already got a margin impact of 1,500. So guess what we can do? Watch this. Let's go. Let's go here. 615 and 600. So what I did is I used 15 points. It doesn't change the margin impact. It does change the shape of the trade. So now I'm not quite getting a credit back. So I have a small debit. And if Tesla doesn't move or it moves up, this trade makes a lot of money. So this is a calendar condor. And what you can do too is, if you want the put that you're buying to time decay slower, then you can push this out on the calendar. Just be aware that this is going to cost you more. It'll make yeah, so it costs more. And now this is a dual calendar spread is what this is. Or no, I'm sorry, it's a dual calendar diagonal or something. All right, so I kind of like this less, because if I'm taking the view that volatility is going to go down, then this is protecting the down. This is taking profit away from the upside target and pushing it into the downside region. So let's flip that back. It's this one here. Okay. So the other thing about it is, what we're really saying is, we're saying if Tesla goes down, we're willing to lose, and if Tesla goes up a lot, we're willing to lose, because we think that volatility is going to be declining. That's what this bet is. Volatility comes out of it, and it moves around in a fairly small range. So these are useful. I put on this week a combination of an iron condor and a butterfly and arc. It uses some of these similar concepts, and so we can look at this on arc as well. And it's going to be similar because of the implied volatility, and that Tesla is a major holding of ARK. But let's take a look at that. So here it is. I've already built it here. I got this when it was much cheaper. And the idea here, you can see the various strikes. And we'll build it in the builder, or we'll build a new one actually instead of this one. But when I got it, the price was around $1 minus $1.50. So I got $1.50 credit for this. On it, that was around my average price around $1.50. I actually rolled it out on the calendar to buy myself more time when Tesla got real cheap. And all right, so let's go ahead and build this. So, because what you want is you there's no reason to put it on if you're not getting a big credit. Like, I wouldn't put this on today right here, where we're not getting a big credit. There's no reason to do it. But if you can get a big credit, then this can be an alternative to the one we just talked about, which I think is it this? Yeah. So here's one of them on ARC. And as you can see, like it doesn't, the risk to reward is different than it was on Tesla, because Tesla's implied volatility is higher. All right, so let's build it and talk about the components of it. Where is ARC right now? 122. Okay, and let's take a look at the ARC chart also. Okay, I mean that's a scary looking chart. If you put on these short volatility positions, here's when you could do much better by timing it carefully. And I'll show you a trick that I use to get good timing on this. So if you look at SPY and you go to like 10 minutes or 15 minute, see the RSI. This is just a standard RSI 14, but it's a 10-minute period. Whenever this RSI gets into the red zone, like that's when you're going to find that you get the most credit for those kind of short volatility positions. Let me zoom out on the chart so you can see more opportunities. So yeah, if you're watching this for the recording instead of live, you can pause it and take a look at all these. And you know it does overshoot and it stays in that region, and sometimes it keeps going. Like here's what you don't want to do. If VXX is breaking out and the VIX index looks like it's screaming higher, then you probably don't want to put on these short volatility trades. But if the market's down and VXX is not in an uptrend, meaning above its moving averages, if it's below a lot of those moving averages, then that's when I would look to do a trade like this. So you see all these periods where that RSI gets blown out. You know, these are the tactical timing opportunities where you'll see that those short volatility positions that we're looking at get really juicy. So that's a tip on timing entry for short volatility trades. So now let's build this one in ARC. I'm gonna look. Let's see here. This is a trade that's all in one calendar. Okay, so sort of like the one that we were just looking at, that calendar Condor, that had a calendar component to it. This one doesn't. What we're gonna do is we're gonna start with an iron condor and we're gonna layer in a butterfly. So you gotta look at the strikes that are available here. So if I do it like, if I start building the iron condor like this, you'll see that the margin impact is 500. This is an important element to this trade. So this is like 86% profitability. Oh, great. The problem is when it's not profitable, look at the return to risk. You know, you're essentially making 10 cents on the dollar. So this is one of those picking up nickels in front of a steamroller kind of trades that they talk about that get people in trouble or get institutions in trouble when they do a lot of this kind of stuff. So yeah, it can win a lot of the time, but when it doesn't, it's big. So let's look at how we can spruce this up. And the other thing is, by the way, like, you know, if you get in trouble on a trade like this, there are follow-up actions and trade repairs you can do. Those guys in Tasty Trade talk about it a lot. And if you want to know follow-up actions, they're covered in this book, some, not a ton. But he does talk about follow-up actions. All right, so in this example, we've got $500 margin impact. So let's see what else we can do here. One of the nice things about, so the current price is 122. Let's go out here. Okay, so let's talk about this. This is now an iron condor. And the reason that Yeah, see, it even says it, Iron Condor. The reason that the margin impact didn't change, but the profit probability did, but the reason the margin impact didn't change is because this is based on what happens at expiration time, and it can't be true that the price is at $140 at expiration and it's also at $100 at expiration. Like, it's going to be one or the other, and that's why it doesn't change the margin impact. So we can exploit that fact. I have to go make big breakfast soon. So all right. So let's layer in the butterfly now. So at Interactive Brokers, the most legs that you can have in a combo is 6. And so we're going to be approaching that here. We're just going to add one new leg. And so the butterfly would look like this. So we're going to buy a 125. We're going to sell 2 130s. Sell 2 130s. Or no, I'm sorry. We were already selling a 130. We have to sell 2 more 130s. So we have to sell 3 130s. And then we, for the Iron Condor, we need to buy one more. I'm sorry, for the butterfly, we need to buy one more of these 135s. So now the trade looks like this. And if you notice, the margin impact didn't change. And however, the shape did. It's now not quite as tall, but you can see that there's a big profit potential right here. And so again, this is based on the idea that when volatility comes out of this, that the price is going to be gently higher. And so that's the idea. And so if you time it in the way in which I showed, and you put on the trade kind of similar like this, you can get like big credits for these. So the credit right here doesn't look really big. It's showing like a $41 credit for $500 margin impact. But you can get this for like $2 of credit sometimes. And so then, it's the profit potential on it is enormous in that kind of a scenario, because you can make so much more. You can make this max profit here plus the credit. So this max profit is based on a credit of $41. And so if you have the credit at $1.50 higher, then this is actually around 700 is where this peak would be. And your max loss is also much smaller. If you get credited $2 for putting this on, the most you can lose is 300. So, however, I mean, the market's in free fall, and so it can look like it could just keep on plunging. So what you can do is kind of average into these, but just be aware that it can get really, really muddy, because you're moving around a lot of contracts here, and you're buying and selling all over the place. And what'll happen is, like, IB gets really confused about what positions you have. In fact, if you put this on, IB just shows you all the contracts separately. So instead of adding more combos, you can instead roll around and try and improve your position. So that's another thing you can do. You can roll these contracts. If you want to roll 2 separate contracts that are split in IB as a combo, you can do that. You can close or roll as a combo individual options that you have as a position. The way to do that is you go into the account tab, you highlight the ones if they're for the same underlying, and you right click and you say close as a strategy, or I think there's a roll as a strategy option as well. If not, then you can just roll it by hand, and that's what I'm doing sometimes for stuff like this that's complicated. I think I generally close it as a strategy and then reopen manually. All right, so yeah, so we talked about this one. What else? Yeah, we didn't talk about the 1-inch punch trade, and I wanted to cover that here in this video because we talk about those all the time. So here's the 1-inch punch trade. it's essentially people call it lottos, or they call it they got all kinds of names for it. Day before expiration. And the idea is that let's look at SPY, because SPY has an expiration on Monday. So let's take a look at that. All right, so just observe the chain here. And look, I mean, this stuff just becomes so cheap. I'll show you something about that. If you were to, say, try and collect a premium on this 392, I mean, I don't trade this way, by the way. I don't just sell naked options. But, I mean, there are people that do that. They'll sell the 392, and then after it fades, they'll sell the 391, and then after that one fades, they'll sell the 390 on expiration day. They just keep on squeezing it. And so I'll do it with, like, a spread, but not outright. So anyway, watch this. If I put this on, is it not going to show me? Yeah. All right. In order to get this up, what happens here is the margin for just shorting this thing, it changes. Like, here, let me short another one out here. Okay. So this margin impact, it changes based on the price. And so it's based on where these options go worthless, or there's some formula or something. But the point is, like, these are basically worthless. And so if you were to cap it out here for 4 cents, it's like they're doing that for you, kind of, with this margin impact. So, like, say I cap it with this crap. And same thing here, something that's 4 cents. Okay, so that really reduced the margin impact. But let's get back to the original intent of that I have here. Is these options are just garbage out here, but sometimes you get a hit, and so a 1-inch punch trade can be made in a few ways. So, like, if we thought that SPY was going to be 3 points higher, or if we thought it was going to be more than 3 points higher than 389. So if we thought it was going to get to like 393 or 394, what you can do is you could do something like this. Oops, why am I selling? Buy a 391 and sell a 393. And so this is, you can make 3 to 1 right there on your money. However, if you don't cap it, you can make more, potentially. The problem is that it's more expensive and the time decay is faster. So the reason to cap it like this is to control the time decay on the call you're buying. That's the reason. So that's how you should be thinking about it. When this call, when you're not worried about that time decay, then you shouldn't be capping it. So when I put on a 1-inch punch trade, I'm looking for 3 things. I'm looking for a chart pattern that looks explosive. I'm looking for a drop in implied volatility in the underlying. And finally, I'm also looking at very short time till expiration. And so another way you could do it is you can put on a call wall, which looks like this. So this is a call wall. At least that's what people are calling it. I don't know what the official name for it is, but I like that name best. It's a call wall. And so this trade for $200, I mean, it can shoot the lights out. You know, if SPY goes up 5% on Monday, then this trade made many multiples of the money. And so, I mean, I've had these trades go where I make 100 times what I put in. I mean, it happens on occasion. That kind of stuff is rare, but you know, it does happen. The other reason to use a wall like this is if you look at the break even. The break even is 392.51, and so it's the break even is much better than what it would be if you're just buying more contracts at like these higher strikes. So this lets you pack a little bit of money in there, and you know, these kind of trades, by the way, I mean, this profit probability of 21%, that's just calculating for you to get to like just past this break even. It's very unlikely to happen. And for you to make big money on these, very unlikely. So these have to be traded at a very small size. I mean, I'm putting in like just tiny amounts into these trades because I mean, most of the time they're going to burn you, and if you're not careful, you're going to burn a lot of money up on time decay because they just vaporize. I mean, one of the weaknesses here is one down move, and these things just all get smoked. So another thing you can do is if you're trying to get in is you can watch for that down move, but generally you're getting in this because you expect that there isn't going to be a down move, and you could do it. You can do it in both directions with calls and with puts. So another variation on it is if you think that there's going to be a big move, you can get a straddle. Looks like this. This is a high time decay, but like if you're not sure which way the price is going to break, these can be good with very little time till expiration. They can be, but I mean, generally I don't do it like this. All right. Well, anyway, we talked about a lot of different combos. So thanks for watching the video. If you like the video, hit like, share the video. It's a new channel. I need your help to get the word out. And thanks for watching. Have a good day.